It's a good time to look at China right now. Obviously, it's Chinese New Year this weekend, but also things have really changed in China in the last couple of months. And we're all looking at it to see what that means for the world economy and for China itself and for investments in China. So the agenda today is to look at the outlook for this year and then the long-term outlook for China, look at the implications for the rest of the world. Then we'll focus in on China as an investment area, in particular looking at the valuations and risks. James will talk about some of the political issues, and Gerry will focus on particular stock markets and the currency. So I'm going to start with the economics and really starting with a sort of long-term view. This is real GDP going right back to the 1990s. I want to just sort of set this up as the pattern we've been seeing. So very strong growth, obviously, in the 90s and early 2000s, then the global financial crisis, and then that long slowdown during the 2010s. And that was a pattern you see across all the data. From growing at 10% or more sometimes, growth was slowing. Right before COVID, it has slowed down to about 6%. With COVID, we've had some big volatility, and obviously 2022 was a particularly bad year. One of the reasons for that was that retail sales were badly hit. People were locked down or feared going out, not necessarily because they feared getting the virus, but because they feared that they might be imprisoned in a supermarket or in a factory or something. So this had a big impact on retail sales. But again, if you look back to the long term, you can see how they were gradually fading over time, even before COVID. And industrial production follows pretty much the same pattern, from high growth earlier on, slowing right down, very volatile in the last 3 years, and very weak recently. Of course, all the data we have is really dates from before the opening, which only happened in December. It wasn't just COVID slowing things down, though, over the last year or two. There was another big problem, which was the property sector. There was really a booming sector in the 2010s. There was heavy speculation. It was seen by many people as their favorite way to hold savings. Many of the properties were simply held empty. It's essentially like land in the sky. You just have a flat in a building, but there's no appliances. Often there's not even any drywall or partitions. So it was really seen as very much as an investment, and it was quite common for people to hold 2, 3, 4 or more properties just as a way to invest, but without letting them, as I said. That all began to change in 2020 when the government became concerned that the property sector was really out of control, that risks were rising, there was too much building, too much speculation. And so they came in with the so-called 3 red lines rules, which limited leverage by developers. The aim was really to strengthen the property developers' balance sheets, but also to slow the market and bring it into what they hoped would be a soft landing. Well, it wasn't a soft landing, it was a really hard landing. Obviously, there was a lot of focus on the Evergrande default. Evergrande was the second largest developer, but 26 other developers defaulted in 2022. There was about $30 billion in offshore bonds in default, but also a lot of onshore bonds as well. And that led to really a collapse in confidence by buyers. The difficulty is that if the developer might go bust or might default, how can you be sure that if you put a deposit down that you'll get your flat? And it's even worse in China in a sense, because the deposit wouldn't be just 10 or 20%. Often it would be much larger than that, and it would be financed by a mortgage. And the way the system works in China, if you have a mortgage on a as yet unbuilt property and it doesn't get built, the bank can come after you, not just the developer. So obviously that made people very reluctant to buy property, except if it was a state-owned developer. This led to a collapse in construction investment, and this has had a huge impact on the economy because real estate supports about a quarter of economic activity. Some estimates put it even higher than that. That's everything. That's construction, that's the materials that go into it, that's the fixtures and fittings when they're put in, and so on. But that's about a quarter of economic activity. So you can see that residential floor space prior to 2020 was growing, it's up and down a bit, but at about 10% a year. So if you consider that's 25% of the economy growing 25% of the economy going 10% a year, that's a big part of GDP growth in recent years. It's now collapsed, and latest is about 40% down year on year. So that's still feeding through the economy and will continue to do so, but to some extent even this year. Government is now trying to boost the property sector. They've essentially abandoned the 3 red lines. They're providing money from state banks to developers to finish buildings that have been left unfinished. They're also trying to encourage buyers by lowering mortgage rates and also down payments. And I think the view is this should eventually provide a floor, but any recovery may be quite slow. Many of the developers are still weak. That's gradually changing as some of the private ones get taken over by state enterprises. But the banks are also somewhat cautious about helping out, and buyers may stay cautious for a while. So we've probably seen the worst of the collapse, but I'm not expecting this sector to roar back. But for the economy as a whole, I think we are looking at a pretty strong bounce for this year. Consumer spending should rise after the COVID wave. It's a huge wave. Estimates for what percentage of the population is affected is somewhere in the 50 to 70% range. So that's hundreds of millions of people. We don't really know because the government is not publishing data. The number of deaths is almost certainly going to be a 7-figure number, somewhere in the 1 to 2 million range. Some estimates put it at. But it is affecting pretty much everybody. And obviously with Chinese New Year, people going back to the villages, it's really going to spread fully across the country. So whereas a few weeks ago, some of the epidemiologists were saying there would be 2 waves, now they seem to think there's just one big wave going through right now. And it should be really going down again as we go into February and March. So we should then see a gradual return to normalcy in terms of spending and going out, and also in terms of factory operations, business operations, and so on. Another reason for thinking that spending will rise is that China, as elsewhere, has this excess savings built up, around 5% of GDP, I think, in China's case. So to the extent that people are willing to spend that, willing to go out again, there's quite a good backup of spending available. We should also see a recovery in investment, which has been weak as confidence returns. So this year, I think, is expected to be quite a strong bounce, starting probably sometime around March. But then I would argue that growth will settle back to the lower trend after that. And I want to explore some of the reasons for that. One is that the labor force is now declining. 20 years ago, the labor force was rising very rapidly, both from population growth and from people moving from the villages. Now population growth is turning negative, and labor force growth already has. But also there's fewer young people to pull in from the villages now. So process of urbanization is slowing right down. Another headwind is reduced access to Western technology. Now, of course, China can develop its own technology to some extent, and they're good at that. But compared with the past, when all they needed to do was to bring in a few Western machines, build a factory, bring in workers from the countryside, that's going to be more difficult now that there's more restrictions on exports. Productivity growth has already slowed. This is labor productivity growth. It was running about 15% in the 20 years to 2013, already slowed down to about 6% pre-COVID, and this is likely to slow down further. There's a big problem of overinvestment. I'll show you a chart on that in a moment. And there's also too much debt in the economy, which means that whereas during the 2010s, China was able to maintain economic growth with the help of just adding to debt, that option is not a good one. The government's trying to avoid that, and that suggests a slower growth rate. So we're thinking the trend growth now in China is probably realistically around 3 to 4%, perhaps even a bit below. Whether the official numbers will say that is another matter, but it's most likely on a relatively slow trend. Here's a picture of investment as a percent of GDP. If you look back to the 80s and 90s, it was running about 35 to 40%. Now that was already relatively high compared with Japan and Korea and Taiwan, the earlier miracle countries. And I think that goes to the sort of wastefulness of the Chinese investment approach. But look at the 2010s, it was up at around 40, 45%. That's huge investment, excessive, they've overbuilt. Whereas most developing countries have poor infrastructure and is actually holding them back, China's gone to the other extreme. So the infrastructure is superb, particularly on the coasts, but increasingly inland, and it's well ahead of what they need. So there's a lot of white elephant projects and projects that might make sense in 10 years' time, but don't now. And of course, if you're only growing 3 or 4%, it takes much longer to sort of grow into that excess infrastructure. So investment is likely to slow down and probably has to slow down. That will slow economic growth. Here's the picture on debt, rising from 100% of GDP up to close to 300% today. You'll notice that in the early 2000s, this ratio was pretty flat. That was a strong growth period, and China did very well then, growing strongly, had the benefit of WTO membership, it had the benefit of major economic reforms in the late 1990s, and they did really well for a period. Then along came the global financial crisis, and of course they instituted a big fiscal stimulus. You can see the jump in debt there. And then since then, debt has continued to rise. They've periodically tried to slow it down, and that's seen a slowdown in the economy, and they've had to respond by pushing debt up again to get the economy going. So now they're up at 300% of GDP. And this is a problem area. I'm not saying this necessarily implies a crisis, because most of the debt is in government entities, owed to government entities, government banks. But it does mean there's a limitation on how far they can generate growth from debt going forwards. Another problem they have is that the government deficit is already quite large. And if you look at the 2019 column, this is before COVID, obviously, they already had quite a large government deficit. It's 6% of GDP is okay for a very fast-growing country, but now they're slowing down, that's a problem. And if we look at the so-called augmented deficit, which includes the local authority investment vehicles, it's about 12%, or was about 12% of GDP. Much of the local authority spending was essentially financed with land sales. And of course, that slowed right down with the difficulties in the property sector. So again, this is not a crisis for the government, but it does mean that there really isn't a lot of fiscal space in China to deal with things anymore. Whereas even back in 2014, I think the situation looked much better. One problem they don't have is inflation, which the rest of us have. You can see the blue line is the CPI at about 2-3%. The producer price index spiked during COVID, during the problems with lockdowns, but has come right down again to negative areas. So no inflation problem. But I think the reason for this ultimately is that China is in a kind of deflationary or position. There's overinvestment. So that tends to put a dampener on price increases. So I've said there'll be a big boost to China this year, and I think that could have quite an impact on the rest of the world. I mean, right now, it means there's low demand for goods and energy, but there may also be some short-term supply chain issues being created as we speak because of problems with production. So right now, I think the very low prices we're seeing for gas, natural gas and oil in the world, not very low for oil, but lower than we might have expected. I think that has a certain amount to do with the weakness in China. And all that is deflationary in the short, disinflationary in the short term. When China bounces back, that's all going to reverse. So we're going to see quite strong demand in China, from China. We also should see the supply get back to normal. So that's a sort of mixed impact on inflation in the West. It could help with Western economic recovery. If you think the path for the US and Europe is going to be a weak first half and then looking to recover later on, coming out of a slowdown, then China's bounce back could help. It could also complicate the Fed's and the other central banks' position if you get a boost to economic growth in the very short term when they're still trying to slow growth down. So we'll have to see how that plays out. Another thing we will see is Chinese tourists back, I think. They've been really absent for the last 3 years, but they should come back this year. Turning to the markets a little bit, well, China's price earnings ratio is very low. I'm sure you'll know that Chinese stocks have jumped quite a lot in the last couple of months. And Gerry will show some slides on that in a moment. And you can see that jump just at the far right side of this chart. But if we look at the cyclically adjusted price earnings ratio, it's still pretty low for China, only about 12. Obviously, that compares with much higher levels in the US, even the UK, which we would consider is quite modest on this, is running about 16, 17. India, as an alternative, is particularly high. So in terms of valuations, China looks relatively attractive, I would say. But there's quite a lot of risks, and we tend to emphasize these at Tricio. One of them is weak corporate governance. That covers a lot of issues, but the difficulties of the foreign investor being sure that they're being looked after in particular, but also government interference in companies. We've also seen very prominent government rule changes for certain sectors, the tech sector, the education sector, and of course the property sector. And that has an impact. So there's some concern, but you can't be sure about that. And I guess one way to think about that is that if the government wants to change rules in the US or other countries, private companies have a lot of lobbying power to affect that, to change that, to maybe reduce the impact. But the way the Chinese system works, the lobbying power of private companies is much less. Another risk is US-China relations, where obviously the worst case scenario is something like what happened with Russia-Ukraine, when investors in Russia suddenly found their investments being marked to zero as a result of sanctions and new rules in Russia. Could that happen in China? Well, it could. So that's an outside risk of actually 100% loss on investments in Chinese stocks. In that extreme case where Taiwan is invaded, for example. So that's part of it. But on a lesser scale, US-China relations means there may be more sanctions against China at some point or against particular companies. It may also mean that Chinese companies are constrained, particularly in the tech sector, by lack of access to technology. Then some investors may worry about ESG concerns. There's obviously, people tend to mostly focus on the E, but if you consider the S, one report from a think tank called Hong Kong Watch found that many Chinese firms included in the MSCI index are linked to forced labor camps in Xinjiang. That may worry some people, some clients, maybe not so much others. Some people may take the view that unless there are sanctions by Western governments, it's okay. But it's something to think about. I mentioned Chinese stocks are cheap. One point to mention, I'm sure you're aware, is that even if you don't buy Chinese stocks directly, about 30% or so of the MSCI Emerging Market Index is China stocks directly. It's also about 30% for the Asia Pacific ex-Japan index. So one will probably have significant weight in China if one simply holds emerging markets or Asia Pacific stocks. So I'm going to, from there, now hand over to James to talk a little bit about the politics and how it works with the economics. Over to you, James.
Thank you, John. About politics, Ephraim is an expert, so I won't pretend that I'm actually very good about the Chinese politics. The only thing I will mention, also, which John kind of mentioned already in the previous slide, is Ephraim remember the interference by the government on the tech sector. I think the Ant listing, which is supposed to be a big IPO, which benefit Alibaba, came to a halt, and the government just stopped it. And then you have other things, video games being banned, education sector stocks becomes the business model were no longer legal, and they have to change things. And this is just a typical Chinese government actions. We did a podcast a couple of weeks ago with one of our previous colleagues from American Express Bank. Obviously, you can listen to that again. And one of the things our colleague mentioned, interestingly, is that the Chinese economic policy is always driven by politics. They're so entangled with each other. The other way to look at it is that China technically is a parental system. We could debate whether it's a good system, but as someone who grew up in Hong Kong, I'm actually used to the way that the cultural aspect of being ruled or being governed in a parental way. Therefore, actually, for example, one of President Xi's nickname in China is Papa Xi, a good papa. So basically, that's the image. So that is important, and everything about the politics and economic policies relate to that. And also the need for the Chinese Communist Party to stay in power. And if you think about that way, a lot of things that the Western economists or capitalist people would think shouldn't happen can happen in China. President Xi is looking for a legacy in the modern Chinese history. He already established it because he now has a third term. This is the reason why there's still a risk about way that China want to reunite with Taiwan. Is it going to be military or it's going to be economic? We don't know. But President Xi wants to establish a legacy. So that's something that everyone need to bear in mind. And that again is another policy thing. Parental rule, want to stay in power, President Xi want to establish a legacy. So we expect, and you invest in Chinese shares, that actually there will be continued interference. Now, there seems to be some relaxation on rules or restrictions about Alibaba and Tencent recently. But we also know that actually there are talks that actually the Chinese state government is going to put their golden shares in this important tech company. So they will retain certain control there. And because of that, we have to think outside the box a little bit and say, we have seen the tech sector, we have seen our property sector driving the growth in the Chinese economy and the stock market before COVID hits. Now, the end of zero COVID policy, things have changed. But the sectors that actually were very strong last time may not be the next sector that is going to benefit investors. So interestingly, for example, from ESG perspective, John mentioned about the S and the G side. But on the other hand, we know that China is leading on a lot of renewable and green energy technology. They're actually building a lot of locally made electric vehicles, EV, and the sale is actually going to surpass Tesla, if not already. So these are the things that actually people need to pay attention to. So when you think about going back into China from a sector allocation and stock selection perspective, there's something to bear in mind. And bear in mind also, there's always a political risk there, and there is a risk premium when you invest in China on this. Back to you, John.
Okay, over to Gerry.
Thank you, John. Thank you, James. We're just going to run through the charts here, and hopefully you'll get some inkling of what we're thinking about. In terms of Tricio, I've probably been the biggest China hawk over the last couple of years, and it's been good to see people who follow our research, good to see the Chinese government's actually knocking back a lot of the reasons why we said avoid China. And there's only a couple left, as John pointed out and James pointed out in the ESG section, is that some of the governance, some of the social policies are still a bit questionable in China. And as John and James both mentioned, the risk of China taking some sort of aggressive action on Taiwan can't be put down to zero. But personally, I don't think it's going to happen because there's no upside in there for China or Taiwan. So I'm a bit more optimistic at the moment because, like I said, a lot of the things that were overhanging the China market seem to be waning. And I would be focused on U.S.-China relations. And I kind of hope that given what Russia's doing in Ukraine, U.S. and China can reach some sort of rapprochement and just get on with life. I'm not saying it's going to go back to the 2001 WTO entry, open arms sort of relationship, but hopefully it doesn't get much worse. So what does that mean for stock markets? That means stock markets have some upside, in my view, from current levels. Now, as John mentioned, China does make up around 30% plus of the emerging market index. The MSCI is a benchmark of that. So even if you have no China exposure, but you do have emerging market exposure, you've got China exposure, whether you like it or not. So looking at the MSCI emerging market index, and you can see there's a weekly chart, the purple line is a 50-week moving average, that we started to recover some really good ground in terms of technicals. We're looking for some more upside here. In the past, we've always said you should go local in terms of your emerging market exposure, or at least try to think local. So we've encouraged people to look at Latin American shares and Latin American sector for a long time. Now we're saying, okay, on a broader view, yes, the emerging markets do have upside potential, and we're looking for a bounce back to the yellow line. So that's around the 1270 area. Next slide, please, John. This is looking specifically at the MSCI China Index. And here too, we're looking for a pretty big recovery. We've crossed above the 50-week moving average. That's a purple line. And I'm looking for a shift back to around 100. Right now, we're trading just above 70. So on a percentage basis, that's pretty attractive. Next slide, please, John. Now here we're looking at the Hang Seng China Enterprise Index, which is basically the tech side of the Chinese market. This is stuff you read about in terms of the things that are powering the future, or as James mentioned, some of the e-revolution, which is good. Now, the yellow line down there was the March 2020 low, and you can see that we've recovered it, which is great. And we've also recovered the purple line, which again is a 50-week moving average. These are very positive signals. So I'm looking for a relatively sharp pullback towards 12,000. We're not looking for new all-time highs here. I think, as James and John have both mentioned, there is some overhang in the market in terms of government debt. There's also a shift in policy. We're no longer seeing the go-go, years of let's, worship, or not worship, let's make big headlines about the Chinese company leaders who can actually do things in the internet and social media and stuff like that. That's changed. Now it's a lot more government policy of trying to maintain control. So we're not really looking for new all-time highs here, but we are looking for significant gains. Next slide, please, John. And I think finally for the shares, this is the CSI 300. As you know, this is the biggest 300 shares in the Shenzhen and Shanghai indices. And I think the biggest share is a liquor company, which is fantastic. And what we want to point out here is that when you are taking specific China risk, if you do that, then one of the things to consider is that different indices measure different things. This one measures the biggest 300 shares in those two bourses, the Shenzhen and Shanghai. And the key difference here is that the March 2020 low wasn't broken. And that's actually quite important from a psychological sentiment charting point of view. We've also recovered the 50-week moving average here. So we're looking for significant gains back up to 5,200 at a minimum and the biggest 300 shares. So if your index or preferred index and preferred ETF and or fund has this as a benchmark, that's something to consider. Now, the currency markets. Next slide, please, John. This is the CNH versus the dollar. And you can see it weakened a lot at the tail end of 2022 when everybody was thinking about all sorts of things going on. But in reality, that was just dollar strength coming through the market against everybody. Sterling made new all-time lows. Aussie, Kiwi, Euro, they were all under pressure by the dollar. That's reversed as people start to think that the dollar and the Fed may have peak rates in early 2023, somewhere around 5, let's say, in terms of Fed funds rates, which would basically take some of the steam out of the dollar rally. Is the dollar rally over? We think it probably is for this year. So we're looking for limited upside from here in the dollar. And we'd be thinking that we're probably going to end the year lower. And so for the CNH, that means maybe 6.5 and an extreme 6.35, 6.3. That sort of area is where we think we might end up. Next slide, please, John. And finally, the Hong Kong dollar. And the only reason we're putting this up is because as we had the podcast, as James mentioned, where one of the questions we posed to Alan, our former colleague from Amex Bank days, was why on earth would you pick on the HKMA? Because headlines were made over the last few months by some prominent US hedge fund managers saying that the peg is going to break. That seems unlikely. And you can look back over history and to be, hand on heart, I tried having a go at the peg in the mid-90s during the Asian crisis, and it didn't end well. So it's one of those things where the HKMA has a lot more money than quote unquote you do. And we think that the Hong Kong peg is, the Hong Kong dollar peg is not going to go anywhere. So if you're looking for exposure to Hong Kong shares and stuff on the currency side, I don't think worrying about the peg is up there on things to try to price into as risk over the next few years. John, I think that's it from my slides. Next slide, please. And this should be our conclusion, implications for investors. I'm going to let John finish this up if that's okay. And obviously we're open for questions. Please type them in to the chat box and James will guide us through them. Thank you.
Sure. So this is just really summarizing what we've been saying. China's opening up is clearly going to boost the world economy, probably from about March onwards. And so quite how that plays out, as I mentioned, we're not quite sure whether it will support the economy just at the right time or whether it will make the Fed's job more difficult. Chinese stocks are still on low valuations, despite the rally we've seen, and they offer diversification. There are risks, concerns, and we've been through those, and also ESG worries. At Tricio, our recommendation is still underweight. As Gerry said, in the short term, we can see definite upside just because a lot of the bad news has gone away. But longer term, we are skeptical, I would say, of whether the upside is significant beyond that short term. And finally, just to remember that you probably have China in your portfolio if you have emerging markets or Asia Pacific. So with that, I'm going to open it up to questions.
I think it has been a very interesting discussion so far. Thank you everyone for your questions. Thank you everyone for participating.